extreme weather events have had a great impact on the Midwest and working class communities like those in my Chicago district, and they're often the hardest hit during such disruptions. Climate change is also a risk to the financial sector. Jim Cramer, host of Mad Money on CNBC, in a discussion last week said major institutional investors want nothing to do with fossil fuels because of concerns about climate change. To guard against climate change impacts, the Bank of England has decided to stress test the UK's capital banks, largest banks, and insurance companies against the risks associated with climate change. Will the Federal Reserve follow suit and develop climate-related stress tests?
So we're monitoring what the Bank of England is doing, and those are, by the way, those are stress tests that are not like our stress tests in the sense that they would have direct effects on the bank's ability to make distributions and things like that. They're really trying to make an assessment, and so we'll be watching that carefully. Okay. We haven't made a decision to proceed with something like that.
Good, I'm encouraged. Looking ahead, incorporating climate change into economic forecasts will become more important. Climate disasters such as Hurricane Maria in Puerto Rico or the wildfires that swept through California last year are currently labeled transitory risks by the Federal Reserve. But we know extreme weather events will become more frequent and severe. The likely result, a corresponding increase in economic losses and physical risks, the brunt of which to be felt by communities of color and working class communities. So, Chairman, when the Fed develops its economic forecasts, at what point should climate change shift from being considered a transitory factor to a structural factor?
You know, our forecasts, both the individual ones that FOMC people like me write down and the staff forecast, they're not for the sort of much longer term. They're really what's important is the next year, the next 2 years, the next 3 years. And climate change just operates on a longer cycle than that. Of course, as you suggest, as severe weather becomes more common, and that's connected to climate change, you will see those things, entering the forecast period and it's certainly entering our supervisory practices as well as our economic forecasting.
Okay. In a recent speech at the San Francisco Fed's conference on the economics of climate change, Fed Governor Leo Brainerd said, quote, "By participating more actively in climate-related research and practice, the Federal Reserve can be more effective in supporting a strong economy and a stable financial system." Do you agree with Governor Brainerd's statement? If yes, what more will the Fed do in the future to identify and mitigate the financial risks of climate change?
So I do think it's incumbent on us to do the research and understand the implications of climate change for our supervisory roles and our roles in looking after financial stability. And that's what we're doing. I think it's early days for that, but the public will expect that we do that and that we take the measures that we need to take to make sure that the financial system is resilient.
Do you agree with her statement generally?
That statement I do, yes.
Okay, thank you. Big bank mergers and market concentration. 3 months ago, the Federal Reserve approved a merger between BB&T and SunTrust, which created the 6th largest bank in the U.S. with more than $450 billion in total assets. And the Federal Reserve's own research suggests that the failure of a single $250 billion bank would be far worse for the economy than the failure of 5 separate $50 billion banks. Furthermore, the former FDIC chair, Mr. Gruenberg, has warned that the FDIC would not be able to wind down a bank the size of the combined BB&T SunTrust without imposing significant losses on the Deposit Insurance Fund and potentially destabilizing the financial system. In this light, can the Federal Reserve justify its conclusion that, quote, "this transaction would not appear to result in meaningfully greater or more concentrated risk to the stability of the financial system"?
Yes, I think we can, and I think we did. We evaluate these mergers under a very clear statutory framework, very transparently. We had a number of public hearings on it and looked at all the statutory factors. And essentially, you have two banks coming together to form a regional bank that's akin to or smaller than many of the other regional banks. And it doesn't appear to me to have significant financial stability implications at all.